KSFR programming and podcasts are made possible by the financial support of our listeners. If this program is important to you, please consider making a contribution by clicking on the red Support the Station button at the top of our homepage at ksfr.org.
Here and There with Dave Marash is funded in part by the Riva and David Logan Foundation, keeping watch for the strategies that help create a more informed and just future for all.
Welcome to Here and There. We search near and far to bring you accurate, timely information about important news stories here in New Mexico and the American Southwest, and there, everywhere else. I'm Dave Marash. For most of us taxpayers, feeling the impact of President Trump's signature Tax Reform Act of 2017 came quickly, if modestly. The reduction in withholding rates sped a few bucks across all of employed America, starting early in the past year. Fast food feel-good is what I call it. How the net of all of the changes in the tax codes would affect particular Americans, well, that's what we're finding out about right now. The intended message of the Tax Act, by the way, was not sent to us small fry who spend our money as it comes. It was beamed to those who plan their spending, who know in January 2018 pretty well how things are going to work out in April 2019. They are the Tax Act's intended beneficiaries, the country's biggest corporations and its richest people, who would accrue the lion's share of a $1.5 trillion shift in buying power. The message to them was simple: invest your windfall, and by the way, create some jobs. A recently released report from the authoritative National Association of Business Economics says it didn't happen. When it comes to both capital investment and job creation, the NABE report concludes, quote, the Trump administration's $1.5 trillion tax cut package appeared to have no major impact. So if the bulk of that $1.5 trillion has not been invested in projects that bring employment, where has it gone? And by the way, here's an idle question. What if $1.5 trillion had not been diverted to the 1%, but had gone directly into public benefit programs like roads and bridges and airports and mass transit systems and schools and parks and playgrounds and so on and so forth? One thing's clear, nobody would have been hurt because the winners from Trump's Tax Act are making it quite clear that they don't need to spend that extra windfall money. And of course, if the money had been invested in public benefits, we would all be sharing better public spaces and better public services. And by the way, the people who would have been employed on those public works projects, the people who really need to earn the money that they need to spend, would have shipped it right back into the wider economy because they spent it. What if? What is that we are dealing now today with those new tax rules in 2019. And our guest today, Jordan Goodman, America's Money Answers man, whose Barron's Dictionary of Finance and Investment Terms has just been republished in a 10th edition. And he can not only help us deal with the tax returns questions, he can maybe explain who won and lost and how in the changes that President Trump and the Republicans in Congress enacted in 2017. Jordan Goodman, welcome back to Here and There.
Great to be with you again, Dave.
So for people who are contemplating filling out the new tax forms and either packaging up all their stuff and taking it over to tax preparers like H&R Block, or tackling TurboTax or any of the other online programs, what are the most significant new wrinkles in the 2019 tax reforms that people should be aware of?
Well, a lot of things really did change, both for individuals and businesses, according to the law. It was just passed at the end of 2017, went into effect January 1st, 2018, but it's kind of the implication of it is kind of going on over time. So let's go through some of the areas. First of all, the tax rates came down, and the brackets were changed a little bit. But by far, the majority of the benefit from that went to the upper income people. The previous law, the top bracket had been 39.6%. That came down to 37%. But on 500,000 of income, it had been $1 million. So they have a lower tax rate on a lot less income that way. So that was right there alone a huge benefit to upper income people.
Now, let me ask, Jordan, because I want to pick these things apart one at a time. When the decision was made to keep the 7-step tax ladder of progressive rates and simply lower the rates more or less across the board, what did that single decision, keep 7 separate levels of tax liability and lower the rates on all of them, what did that predict in terms of winners and losers?
Well, I mean, the people with higher incomes have much more benefit than those with lower incomes because they're being taxed at a much higher rate. If you're paying $200,000 in taxes and your rate goes from 39.6 to 37%, you're saving tens of thousands of dollars in taxes. Whereas if you're paying $200 in taxes and you go down, you're saving a few bucks. It's just, that's the way it works. It makes it look like it was equitable because all the rates went down the same, but the benefit was far, far more skewed to the people who earn more income, who therefore in the past paid more taxes, who now pay less taxes.
And there were arguments at the time in late 2017 that maybe instead of 7 different tax brackets, we only needed 4 or 5 or fewer. Did the decision to keep the 7 separate tax brackets also have consequences?
Well, yeah, in the past we've had fewer brackets, and then it's expanded and contracted. We've kind of gone back and forth on this. But the feeling was by lowering the rate, and it's not only the rate, but it's the income that it applies to. That's really almost the more important thing, because the lower rate applies to more incomes, therefore you save a lot more in taxes. So I guess it's a way of kind of making it look good that they kept the 7 brackets, but the impact was great by lowering the amount of dollars that are actually taxed.
Now, talk about looking good or feeling good. The almost immediate reduction in the withdrawal rate did stimulate some consumer activity because it put a few more dollars in just about everybody's hands, but it also helped to conceal the fact that there is a huge balloon payment waiting at the end because the net of this tax reform was to immensely expand budget deficits and the national debt. Yes?
Well, clearly. And now, at the time, these were conservative Republicans who passed this tax reform. And normally they're not the kinds who like budget deficits to go up. But what they said is this is going to stimulate the economy so much that the tax cut will so-called pay for itself. That's the idea. You'll have this huge economic growth and investment, create so many more jobs, so much more income, that the revenues will be overwhelmed in the long run, the short-term deficit because we had fewer revenues. This is classic supply-side economics. I mean, it worked to some extent in the 1980s, but tax cuts even then never so-called paid for themselves, Dave. Never. They paid a little bit, but that's why the deficit went up so much under the Reagan tax cuts and under the Bush tax cuts of 2003. And at least if what we've seen in the last year, we have over $1 trillion federal deficit at a time when the economy is growing at roughly 3%. You can imagine what the deficit is going to be if the economy slows up. So these tax cuts have not, and I think never will, so-called pay for themselves.
Now, the National Association of Business Economics quarterly report said that the economy overall is in good shape, but that, in fact, there were things to worry about, that there were signs that things were slowing down. And I would guess, for my amateurs reading, that the strongest parts of the economy have to do with day-to-day spending. People still need what they need, and they still need to buy it. But the larger the purchase, the longer term the effect of the purchase, the bigger the risk of the purchase, that's where you're seeing the slowdown, and preeminently right now in the housing market?
Well, housing and cars, both of them. I mean, those are the 2 biggest drivers of the economy. And you're right, these are decisions that people have to take. They don't just go say, let's go out and buy a house today. It just doesn't happen quickly. It's a long-term major decision to make, and the same thing when you're buying a car. So the housing market has clearly slowed from where it was before this tax bill went into effect. And there are some specific parts of the tax law we should describe that explain why that's happening. And the car market has slowed down to some extent as well, because people don't want to take on these big expenses for cars. Maybe we could just talk about the housing briefly, David, because that was such a major impact on the economy. Supposedly this is going to be helping the housing market, but the specific part of the tax law that changed, which really hurt the market dramatically, is that mortgage interest and state income tax deductions were limited, as they never really had been in the past. Mortgage interest deductions are limited to the first $750,000 principal. It had been $1 million before that. And then the tax deduction for a combination of state and local income taxes and property taxes, things like that, was limited to $10,000 per year for a married couple. So in the past, now in the high-tax states, in New York and New Jersey and California and Michigan and Connecticut, and where there's high taxes, people were paying way, way, way more than $10,000 in both either property taxes or state income taxes, never mind the two combined. So that has made a major negative impact on the housing market in those states. And I mean, I'm in New York. I'm looking at it right now, where I happen to live in Westchester County, which has got amongst the highest home prices and property taxes in the country. Home sales are down between 25 and 30% now compared to, say, a year ago before this tax law went into effect, because people don't want to take on these huge property taxes and income taxes on a house, whereas before it was fully deductible. Now you're limited to $10,000. So that was an arrow aimed at the heart of the blue states, and it is piercing right now.
And, it had a kind of double point to it politically. Number one, as you say, the high-tax states all tend to be Democratic states by and large, and so it was easy for the Republicans in Congress and the Republican in the White House to penalize them by limiting the deductions you could get for state and local taxes that you had paid. But philosophically, also, the high-tax states are the high social service states. That's what you're paying the higher taxes for. They're the states that invest in a better social safety net and perhaps better public education and public infrastructure. And so in addition to the narrow partisan targeting of cutting back on deductions for state and local taxes, there was the philosophical mandate, do less. Have an inferior social welfare system, and if that means shuffling more people out of public into private schools, well, we're down with that. And in fact, that was another of the changes in the 2017 tax law, was incentivization for parents of school agers from kindergarten on to spend on private education rather than using the public schools. Yes?
That's correct. So the Section 529 plans, which is the way you can save up money for kids' education, in the past had only been good for college, basically, post-secondary. But that was expanded, and now it can be used for K through 12 as well as college. So, yes, that was a way of people saving in a tax-deferred or tax-free way that now help private schools K through 12 as well as college. So that was doing exactly what you said. And the result of that $10,000 deduction, people on the margin are moving from high-tax states to lower-tax states, or in many cases no-tax states, like no income taxes, like Florida and Texas would be two of the bigger examples, because people just don't want to take on these huge tax burdens. And this is a major part of the economy, and this is a major part of the economy in the biggest states as well. So I can't say it wasn't designed that way, but it's had a major, major impact. I'm in Westchester, but in New York City, sales are also down 20, 30% in many cases. Very, very high-income apartments, all these million-dollar apartments. Well, you have a pretty big tax bill, both property tax and state income tax, to own one of those places, and their sales are way down, too. So that kind of rifles its way through the economy. You're going to be building fewer of these things. Realtors are going to get fewer commissions. People, when they don't buy homes, don't buy furniture and carpeting and electronics and all the things that go in them. This is what's called the multiplier effect. So you have less of a multiplier effect when people don't buy homes in the high-tax states.
Well, a perfect example of a political multiplier effect is if you incentivize people to take their kids out of public schools and put them into private schools from kindergarten on, you are also undermining the basis of votes for funding for public schools. People who ain't stakeholders in the public schools anymore ain't going to vote to raise their taxes in order to improve the public school system. And so those familiar school bond issues are taking real hits across the country, in part because the Trump administration and the Republicans in Congress said, well, why don't you save some money by sending your kids at tax-subsidized rates to private schools and let the people who need the public schools fend for themselves.
And you're seeing that, for example, recently with the Los Angeles teachers strike. And this has been happening in states across the country where the schools are so strapped now that the teachers have to take money out of their own pockets on meager salaries to give kids pencils and things like that, and they just couldn't take it anymore. So in that case, I guess it was settled for some increases. But the public schools are definitely being drained, and you're seeing the result of this because the people left in the public schools are those who have no choice. They don't have the money to buy private school tuitions.
Now, the consequence of capping the home mortgage deduction at $750,000 rather than $1 million sounds like, and is certainly meant to sound like, oh, that only affects the very rich. Is that true, or has, in fact, the upper middle class and even the upper portion of the middle class also been adversely affected by the new cap on mortgage income interest deductions?
Well, yeah, $750,000 sounds like a lot, but in New York, in California, there's lots of places where homes are way more than $1 million, and that's going to affect people buying those homes, not being able to get a deduction on that other $250,000. All these things, when you take away deductions, people have a choice, and they're going to, on the margin, not buy something, and they try to keep it under those prices. So it's not only the very, very wealthy that are affected by something like that.
And, the impact is not just on should I buy or should I not buy, but it depresses the price. The more choices
Correct.
you impose or allow to buyers, the more pressure you put on sellers to bring prices down to entice those buyers.
And they've been doing it. I mean, prices are coming down in the high-tax states. And this is, in many cases, the main asset that most people have built up over many years. And in many cases, they want to sell it to fund their retirements, and they're going to be getting a lot less. It's not quite the same, but it's almost like 10 years ago when you had the crash of 2008, 2009. People were expecting to retire, and their nest egg was cut in half quickly. It's not quite as dramatic as that, but in many cases, if you get 20, 30% less than you were expecting on your home when you're selling it, that definitely affects people's ability to retire in a more comfortable way.
So let's proceed now from that first pair of actually paired big changes in tax deductions, the capping of the tax deduction for home mortgage interest and the capping of deduction for state and local and property taxes. What were some of the other major changes in the 2017 law?
The standard deduction was increased dramatically. It in effect doubled. The standard deduction had been, it had been $12,000 for couples. Now that's at $24,000, and for individuals, for singles, it had gone from $6,000 to $12,000. So in one way, that simplifies filling out your taxes. And I think you're going to see that this year. Something like 80% of filers are not going to have deductions anymore. They'll just take the standard deduction, so it makes it easier to file. So that's the good part. The bad part is that you're going to be losing itemized deductions for all kinds of things we've been used to: mortgage interest, charitable contributions, all kinds of business expenses and so on that people used to get are not going to be deducted anymore. And you're already seeing, for example, charities apparently have been getting less contributions than they did in the past because those are no longer deductible if you use the standard deduction. So it makes it look good. It's kind of the same thing, but in many cases, the people who are getting those contributions, qualifying for those deductions, aren't getting them anymore, and charities are already getting hurt, and it's going to hurt them even further.
Well, of course, that brings up a question that almost all taxpayers are facing. What's the break point? When does it make more sense for me to go through the tedium and extra work of taking itemized deductions and going long form rather than taking the invitation to the easy route, give up those itemized deductions, but just fill out the standard short form?
Well, I mean, if your deductions are more than $24,000 for a married couple or more than $12,000 for a single, if you have itemized deductions more than that, then it would make sense to itemize. But again, 80% or so of Americans are not going to have that level of deductions, and so they're going to be doing the standard deduction. And by the way, while we're at it, many miscellaneous deductions that people have been used to for a long time were also eliminated. And I'll just give you a list of some of those, Dave. Investment advisory fees, tax preparation fees, trustee fees, unreimbursed business expenses like car, home office expenses, meals and entertainment, union dues, uniforms, moving expenses, subscriptions, safe deposit box fees, unreimbursed casualty and theft losses were eliminated, except if it was a kind of a national disaster. So a lot of these things that people were used to are not going to be deductions anymore. I mean, this is if they have itemized deductions, but that's another reason people are going to go standard deduction, because a lot of things in the past that were deductible are no longer deductible.
So that, again, it's not just a procedural change, but in terms of the net of your tax liability, the erasure of all of these former deduction options could, in fact, wind up raising your tax bill.
That is correct. And another one in the medical area, medical expenses that are over 7.5% of adjusted gross income were made deductible for those who itemize in 2017, 2018, but after that's going up to 10% of adjusted gross income. So you have to have a lot of unreimbursed medical expenses to be able to qualify for that deduction, and most people are not going to be able to reach that either. So health expenses for the most people will not be deductible anymore either.
And again, for average taxpayers, this is going to be a net loss as they file their taxes. We're going to take a brief pause, and then we'll get back into some of the details and the impact of the details of the new tax law that we're all wrestling with for the tax filing period that we're in the middle of. But as I say, we're going to take a brief pause. This is Here and There. I'm Dave Marash. Our guest is Jordan Goodman, America's money man, money answers man, and we'll get more money answers from Jordan right after these messages. Welcome back to Here and There. I'm Dave Marash. Our guest is Jordan Goodman, America's Money Answers man, whose Barron's Dictionary of Finance and Investment Terms is out in a brand new 10th edition, a very useful handbook for those of you who, like me, rarely engage with finance or investment, and a lot of intricate details are clarified and simplified in a good way in Jordan's Dictionary of Finance and Investment Terms. Anything that's in its 10th edition has clearly established enduring value. So thank you, Jordan, and congratulations for that. In addition to the change in itemized deductions, the personal deduction was completely eliminated. What was the personal deduction, and what are the consequences of its elimination?
It's the personal exemption is what it's called.
Exemption, rather, sorry.
Yeah, and it was $4,150, and that was completely eliminated. So each person would get $4,150, which lowered their taxes by a significant amount, depending on their tax bracket. So that was eliminated. So this was kind of an incentive to have more kids or more people in your family. That is now gone. So you don't get a break by having more kids. Let's put it that way. So that's in itself is going to raise a lot of taxes for people if they don't have that personal exemption anymore.
Well, again, a single lump sum deduction across the board like that will have disproportionate benefits at the bottom of the income levels, just as dropping tax rates for all of the brackets in the tax code benefits those at the top, whacking out the personal deduction. By the way, I don't know that the American birth rate is so out of control that it needed discouragement. But in any case, the net of that hurts the bottom more than the top, just as
it's much more significant to have a personal exemption for $4,000 when your income is lower than when your income is higher. That is correct. But there were other things that actually helped the upper income people we haven't even gone to. For example, estate taxes, and a major change there. That was widened out dramatically, so far fewer people are ever going to pay estate taxes under the new tax law.
Yeah, under the new tax law, how large an estate do you have to have before Uncle Sam can lay even a single gloved finger on it?
So the lifetime exemption for estate and gift taxes was raised to $22.4 million for a married couple and $11.2 million for an individual. So if you have over $22.4 million, then you'll have a tax rate of about 40%. And those exemptions, by the way, will be increased over time with inflation. So that means the vast majority of Americans will never have to pay estate tax. But the people in the $5 and $10 and $15 million range who in the past might have paid some estate tax are now not going to, as you say, have a glove handed on them at all.
And so now, if you took everyone in the United States who is going to be assessed an estate tax and herded them into a single athletic arena, they wouldn't even half fill Madison Square Garden.
Well, the actual numbers for 2017, there were 11,300 estate tax returns filed. That's for the old law. With the new one, estimates are actually I have something here from the Urban Tax Policy Center projects that there will be 4,000 estate tax returned this year. And only 1,900 of those will actually pay any kind of tax at all. Very, very few, as you say. It's gone from 11,300 down to about 1,900 people will be paying estate tax. It's pretty much wiped away for most people.
Now, I would guess, and this is an amateur's guess, that the single most damaged group by the 2017 tax bill were tax preparers. Not only are taxpayers being nudged towards going short form and not paying tax preparers, but the cost of using one that used to be deductible is no longer deductible. H&R Block must have fallen into one another's arms weeping at this news.
Yes, it's true. I mean, the tax code is still complicated, but you're right. The average person who's going to do the standard deduction and not have anything fancy can do it on his own, or can certainly use an online service, TurboTax or something like that. There's going to be far less need to use a tax preparer. I agree. The upper income people still has a lot of games to be played, and then the other side we haven't talked about is the business side, and that was more complex. There's a lot more tools to be used there, but you're right. The average individual is going to have far less need for a tax preparer than the past.
Now, writ large, the big changes in the business tax, and they parallel some changes in the personal tax, is to tighten down on what is an eligible business expense, and particularly on the kind of social entertainment side. A lot of things that formerly could be deducted as an expense, you no longer can do so, and I'm guessing that maybe right behind H&R Block and weeping about this would be the middle to upper end of the restaurant business, because a lot of the meals that they sold that used to be sold at a taxable discount because they were deductible are now full price.
Yeah, I mean, that had been cut back in the past to a 50% deduction. It had in the past been 100%. Lately, it's been a 50% deductible for business meals, and that, you're right, in many cases now goes down to zero. So that'll hurt restaurants, you're correct.
Again, in a place like Westchester County, where you live, where a higher than normal percentage of the restaurants, charge a fair amount for their meal, the change in the tax code has done them no favors.
That's correct. That's correct. But I must say, overall, Dave, the businesses are not complaining about this tax bill. The deduction for a business meal is peanuts compared to the major benefit, which was to lower the corporate tax rate from 35% to 21%. That's where most of the money in this tax bill went. And you saw it. Corporate profits in 2018 were up in general about 25% over 2017, their business being pretty much the same just because of the windfall from lowering the corporate rate from 35 to 21. So the businesses are really happy about that, and they're not complaining about not having their business meals being deductible anymore.
So the fact that they got this enormous windfall, and estimates are well over $1 trillion out of the $1.5 trillion total of money diverted from one pocket to another of the economy. If they're not reinvesting it in productive ways that will expand plant and create new jobs, how have they used that windfall money?
Well, some have done capital expenditures, but a company is going to increase, not just build a plant or add factory capacity if you don't think there's going to be demand for what they're doing. So a lot of companies said, no, we don't really need more plant and equipment, or not a major amount anyway. So the two major things they did with it is they bought back their company's stock in huge amounts, something like $700 billion in stock buybacks last year, which supports the stock price. It also raises earnings per share, because if there are fewer shares outstanding on the same earnings, your earnings per share goes up, and that tends to make the stock price go up, and the top executives tend to have their compensation based on earnings per share or the stock price going up. So it benefited the top executives. So that was one thing, the stock buybacks. They also increased dividends, paying out the cash to shareholders in various ways. And again, all the benefits of that go to people who are shareholders, which tends to be higher income kinds of people, and mergers and acquisitions. And we saw a huge amount of major mergers and acquisitions. If these companies don't feel they can invest profitably in their own business with capital expenditures, they're going to go buy other companies, leading to more concentration in many, many fields. You saw that in the media world, you saw it in food, you saw it in telecommunications, you saw it in energy, utilities, banking. I mean, many, many fields. You saw a huge amount of mergers and acquisitions with this windfall. So that's where most of the money went.
Now, many of the sort of financial innovations that you referenced actually over the last minute or two, the way in which executive compensation has been tilted towards stock benefits and registering on short-term profits, almost all of them have focused management on short-term as opposed to long-term, both benefits and investments. Sounds to me like the Trump Tax Act had a huge multiplier effect on that, and re-emphasized for the 1% that you can redouble your money the more short-term your focus and the more short-term your investments. Is that fair?
Well, that's right, because if you buy back stock, that's a short-term situation where it boosts the stock temporarily. If you raise dividends, that helps the stock, in the short term. Long term is making major capital investments, and some companies are doing that. Apple announced a new campus they're doing. Amazon's going to add these new campuses in New York and Virginia. There have been some major capital expenditures as well, but most of the other things were aimed at short-term boosting the stock, which worked. For the most part, the stock market's gone up since that tax bill. It fell off at the end of last year, but in general, the stock market has done very well. The shareholders have done far better than the workers at these companies because of this tax bill.
And again, most measurements of the economy suggest that it is doing just fine, but they tend to be the broadest scale measurements, and things are definitely finest the higher up the scale of the economy you go, and least fine the farther down the scale of the economy you go. So that, again, that old bugaboo, inequality, there was a tremendous inequality multiplier effect in this 2017 tax reform.
everything we've talked about so far has shown how it helped upper income people, both on the personal side, and we're now talking about the business side as well. One specific thing we haven't talked about yet, which was a major, supposedly, incentive to small businesses to expand, was the expansion of the so-called pass-through entity law. This is where you have some kind of a limited liability corporation or limited partnership or subchapter S corporations. These are the medium and small-sized businesses that do drive employment in this country. The new law says the first 20% of their qualified business income became tax deductible. That's a major change, because that means that these medium and small-sized businesses can keep more of their profits, in theory, to reinvest and expand and hire and so on. I don't think it's exactly happened yet, but again, the people owning these kind of businesses would be a major beneficiary of that deduction that did not exist before.
Now, I know that in several states, Kansas being most notable among them, the expansion of pass-through options for businesses didn't so much stimulate the economy as they stimulated a polite kind of tax fraud in which businesses suddenly discovered that they were eligible for the pass-through, and so they rewrote their tax liabilities to their own advantage. But for their participation in the wider economy, there was no change other than the proprietors being able to pocket a little bit more of their cash flow.
That's correct. So these companies that had been structured as a regular corporation, which is not a pass-through entity, became pass-through entities like an LLC or limited partnership or subchapter S, which are pass-through entities. So you're right. They just changed this corporate structure to take advantage of it. Now, in theory, the reason that would be good is these companies would then be more profitable and use that extra profit to expand and hire and buy equipment and, make. That's where the growth is in this country, is jobs. If you've been seeing, we've had these great jobs numbers lately, but almost all of that job increase is happening at the medium and small-sized business area. So I don't know if it's actually happened yet, but that was the theory behind it. Make it more profitable to run a medium and small-sized business, and they'll have higher, more job growth and more expansion.
And again, one of the theories that was offered in support of this was that if you can lower the unemployment rate, get more people hired, that will bid up the cost of labor. But so far, at least, the rising tide of wages, which in the past few months has started to nudge up, but it's still running way behind the rising curve of tax benefits that have gone to employers. And the number of people being hired has not yet pushed up the number of the salary packet that they're going to bring home with them, at least not yet.
It depends on the industry. I mean, there are certain industries where there's a tremendous shortage of workers in computer science, and construction. There's a lot of jobs available out there, Dave, because the baby boomers are retiring. We always hear about the unemployment numbers, but there's another side of that, which is what's called the job openings report, or what's called the JOLTS report, which lately has been saying there are 7 million jobs unfilled in this economy, and that's mostly because baby boomers who are hitting their 65 and later are retiring. And a lot of younger people either are not interested, are not trained, or do not want to take these jobs. So in those areas, there is wage inflation, and wages are going up because you've got to do something to get people to do these jobs. And there's certain industries, again, high tech, there's a huge shortage of people. That's why we have to import people from India and China to fill all these programming jobs, because Americans either don't want to or just are not trained to do so. So in those areas of the economy, there is wage growth, but there isn't much wage growth if you're, a nurse in a hospital or a fast food worker or, municipal worker, things like that. There's a big disparity between those two.
And again, the fact that the tax codes encourage and the business laws encourage the importation of IT workers from South Asia. Well, if we invested more in public education and public colleges to create our own cohort of IT workers, they would make such imports less necessary. We're going to take another brief pause. When we come back, I want to ask about one of the ornaments of tax politics of the 1990s, if I'm remembering correctly. The alternate minimum tax has also been adjusted in the new law, and I want to ask about the impact of that. But first, we're going to take another brief pause. This is Here and There. I'm Dave Marash. Our guest is Jordan Goodman, America's Money Answers man, the author of the Barron's Dictionary of Finance and Investment Terms, out in a brand new 10th edition. We'll be back right after these messages. Welcome back to Here and There. I'm Dave Marash. Our guest is Jordan Goodman, America's Money Answers man. The AMT, Jordan, the Alternative Minimum Tax, when it was put into place, it was put into place as a guarantee that a lot of upper middle income people who had managed successfully to reduce their taxes to minimal levels would have to contribute at least some floor level of taxes back to the federal government. What happened to the AMT in the new tax law?
It was widened out so many fewer people are now going to be paying the AMT in the past. The exemption on the AMT was raised to $109,400 for married couples and $70,300 for singles. The phase-out threshold was raised to $1 million, meaning you have to really get up there before the AMT is going to kick in. So basically, the AMT is going to affect far fewer taxpayers than the past. So those high-income people who are going to play all these games are going to find ways out of it because the AMT is not going to catch them as it did in the past.
So it has broadened the tax shelter for above-average income earners.
Correct. I mean, the idea originally, this was put in the late 80s under Reagan because there were all these tax shelters at the time. People were making huge amounts of money, and because they were buying tax shelters, they were avoiding paying taxes. So it was always a mess. It was always complicated to figure out your taxes one way and then to do it through the AMT way. But it did raise some significant revenue, and now they'll get less revenue from the AMT.
Now, we've already pointed out that the theory that raising or lowering the tax rates has a direct impact on investment strategies and commitments, and the theory was that by sending $1 trillion windfall to corporations and very rich people, that they would turn around and reinvest this money to stimulate the economy, and that has certainly not happened yet, and again, it's only been in effect for a year, but so far not. But as you pointed out, that's because people don't make future investments based on present tax rates. They base them on their assessment of future markets. And the fact that so little of the windfall money has been reinvested seems to me to be strong evidence that the people with that money are not highly confident of the growth in the American domestic market. And as far as global markets are concerned, the Trump tariff and trade war policies have created tremors that seem to have depressed the whole global investment scene.
Well, very much so. I mean, Europe has definitely been slowing down, and we've got hanging over us the possibility of higher tariffs on auto and other parts from Europe. The whole situation with Brexit is causing tremendous consternation. I think what's likely at the end of March is you'll have a so-called hard Brexit, meaning Britain exiting the European Union with no deals, no rules. We have no idea how this is going to happen or how trade's going to work. Basically chaos in Europe. And then our ongoing fight with China. We've put 10% tariffs on $250 billion of their products. We're talking about raising that to 25% come March 1st, and potentially raising it to all products coming in from China, which was well over $500 billion. That has clearly slowed the Chinese economy dramatically, and it's hurt Americans. Soybean farmers used to sell $16 billion worth of soybeans to China, and lately it's been zero because they're not buying from us, and various other exports they are not buying from us as well. If we could get that resolved, that would certainly help economic growth because the U.S. and China are the two largest economies in the world, and having this battle like this. And I'm frankly thinking it's not going to happen, Dave. I do not think that the Chinese are going to accede to our demands for major structural changes in the way they run things over there. And so we're asking for things, I think, that are almost impossible for them to deliver on. They have something called Made in China 2025, which is major investments in all the latest technologies, artificial intelligence, cloud computing, robotics, and so on. They say, no, we don't want you to invest in those kind of things. I think the Chinese are going to say, no, we want to invest in the future. We're asking them not to steal our intellectual property. I agree it's wrong, but that's what they've done forever. They don't even admit it's a problem, never mind say they're going to change it. We have what's called forced technology transfers, where American company goes in there, has to kind of turn over its blueprints and its technology to a Chinese company so they can copy it. I agree it's wrong, but I don't think they're going to change their policy on that. We're asking them to not subsidize so-called state-owned enterprises, big steel and aluminum plants that are highly subsidized to employ a lot of people. We're saying don't do that anymore. Well, that would lay off millions of people in China if they're not being subsidized. So those are just some examples of things we're asking for that I think are structurally the way they do things, and they're not going to be able to give up on those things. And therefore, I don't think we're going to get a deal, which means tariffs are going to go in higher and hurt both the U.S. and China.
Well, I would have to say that among the most malign aspects of Donald Trump's dementia is his zero-sum approach to international trade, which is it's a competition, and if we win, we win, and if the other guy loses, we win, so that by doing damage to the Chinese economy and slowing it down, we're winning. This is crazy. Because
it does not work that way. It is really rising tide lifts all boats. One of the miracles of the post-war era has been the rise in global trade, has brought literally hundreds of millions of people out of poverty. In China and Latin America and in Southeast Asia, when you have more trade, both sides benefit. Mexico is another example. There's a lot of Mexicans now that are doing quite well because of trade with the U.S., because of NAFTA. So you're right. It's not a zero-sum game, and he sees it that way. And the people who lose don't want to lose, and China feels in a pretty strong position to resist this. They've got what's called the Belt and Road Initiative, where they're investing something like $8 trillion, with a T, $8 trillion in about 70 countries to improve infrastructure and ports and bridges and trains and roads and trading and all kinds of things. They're not going to back down on these things just because they're raising tariffs on them.
Now, one of the ballyhooed aspects of the tax law were encouragements to American corporations who had stashed profits abroad to hide them from the tax man, to repatriate them, bring them home, and let them flow into the American government coffers. How has that worked out? Has the incentive actually brought a lot of hidden money back?
Yes, it has. It has. The big real difference there was our tax rate going from 35% down to 21% put us kind of in the middle of the pack. 35% was at the top of the. So yes, some companies have definitely, Apple being one example, have brought some money back to invest in the U.S. So that's helped a little bit. But we're still not at the bottom. I mean, the bottom of the list of corporate taxes, like Ireland, has I think 12% tax rate. So that's why you see a lot of companies wanting to invest in Ireland because they have very low tax rates. So it's better, but we're still not leading the pack on corporate tax rates.
Now, one of the other changes was on the rules for capital gains treatment. Capital gains, of course, taxed at a much lower rate than ordinary income. Under the new tax law, you now have to hold on to stocks for a 3-year period for them to become eligible for that lower tax rate?
That's only in this very specific case, which is what's called carried interest, okay, to get the long-term capital, which is basically what hedge funds use. That does not apply to individuals. If you are an individual, you have to hold a stock just for 1 year to get the lower capital gains rate. That 3-year is only relating to carried interest.
So this was, in effect, a reining in of the hedge funds?
A little bit, but a lot of people think that carried interest deduction should be taken away altogether because these multi-billion-dollar hedge funds are, they're doing just fine, and they don't need that huge tax break. So the original proposal was to get rid of carried interest altogether and make the income that hedge funds earn be taxed as regular income instead of capital gains. This was like a medium. But for the most part, hedge funds still are able to get away with having this carried interest deduction, where they can have capital gains rates on really what is income.
And of course, to just light my fury a little bit more, one of the details that I learned by reading the section on the new Tax Act in Jordan Goodman's Dictionary of Finance and Investment Terms is that the tax bill, in addition to all of these financial changes, opened 1.5 million acres of the Arctic Wildlife Preserve in Alaska to oil and gas drilling at a time when there is already a virtual glut on oil and gas in the United States.
Correct. And President Trump, on the campaign trail, was saying we finally got ANWR open. It was kind of thrown in there at the end. That's correct. And that will now be developed. I mean, the original development in Alaska has been dwindling for quite a while because that these ANWR lands have not been able to be drilled. Now they will be drilled. So there will be more oil. But you're right. We almost do have a surplus now. The U.S. is producing something like 12 million barrels of oil a day, and this will just add to that more. It makes us energy independent. Of course, the reason people didn't want this is they're worried about some big spill. This beautiful wild land could easily be despoiled if there's some big oil spill. And we've had oil spills in Alaska before.
Yeah, it's good news for Exxon, maybe bad news for the Inuit or the moose. That's gonna have to do it for us. I want to thank our guest, Jordan Goodman, America's Money Answers man, who proved once again what interesting answers he provides to money questions. And again, I remind you of the brand new 10th edition of the Barron's Dictionary of Finance and Investment Terms by Jordan Goodman. Jordan, thanks so much for joining us again on Here and There.
Thanks so much, Dave. Appreciate it very much. Thank you.
That's our story for today. I'm Dave Marash. Research and production assistance for Here and There by Amy Marash, Ann Silberman, and Mary Lou Cooper. Operational control by Sean Conlon. Our theme is by Kate Powell. Here and There is a production of KSFR-FM 101.1 in Santa Fe, New Mexico. You can find program notes and listen to podcasts on our website, davemarash.com. Subscribe to Here and There on iTunes, Spotify, or Stitcher, or listen online at ksfr.org. Follow us on Twitter at Dave Marash, KSFR, and on Facebook at Here and There with Dave Marash. Join us again when next we go Here and There in search of news. Here and There is funded in part by the Riva and David Logan Foundation, keeping watch for the strategies that help create a more informed and just future for all.